Dear professional student, you are welcome to another session of derivative valuation and analysis. In this session, we want to be looking at derivative markets, valuation, and derivative market instruments and valuation. And we are talking of derivative market. Derivative markets refers to financial market for financial instruments such as underlying assets and financial derivatives. And when we are talking of this market, there are certain participants in this market. Or before we go further, when we are talking of derivative market refers to the financial market, as I said earlier, for financial instruments such as underlying assets and derivatives. And there are certain participants that we have in this market. We are talking of participants. Participants in the derivative market can be categorized into four. The first one is that we have hedger. So when we are talking of hedger are person. Hedging is when person invests in financial market to reduce the risk of price volatility in exchange market. That is, to eliminate the risk of future price movement. That is one. And derivatives are most popular instruments in the sphere of hedging. It is because derivatives are effective hedges in correspondence with their respective underlying assets. That is one. We have hedger as one of the participants. Secondly, we have speculators. When we are talking of speculators as one of the participants is the most common market activities that participants of a financial market takes part in. It is a risky activities that investors engage in. And this concept involves the purchase of any financial instrument or an asset that an investor speculates to become significantly valuable in future. Speculation is driven by motive of potentially earning lucrative profit in future. That is about speculation. So a speculator tries to make much money in future by taking the bet on the market. It is like a betting, it's like a forecasting that certain thing will happen in future and you take position accordingly. That's a speculator. And arbitrator, this is another financial participant, derivative market participant. Arbitrator is a very common profit-making activities in financial market that comes into effect by taking advantage of or profiting from the price volatility in the markets. An arbitrator make a profit when the price difference arises in investment of a financial instrument such as bond, stocks, and derivative itself. That's about arbitrator. And the last one we have is margin trader. And we are talking of margin trader in finance industry. Margin is the collateral deposited by an investor investing in financial instruments on the counterparty to cover the credit risk associated with the investment. So that's the marginal trader as for all the fourth participants we have in the market. Now, aside that, there are type of derivative contract we have. When I'm talking of type of derivative contracts, derivative contracts can be classified into four types. The first one is option. And when I'm talking of options, option are financial derivatives contract that gives the buyer the right. Please note it, give the buyer the right, but not the obligation to buy or sell the underlying asset at a specific price, which is known as strike price, during the specific period of time. So we have American options, which can be exercised at any time before the expiration of the option. And we also have we have other options such as the Rosa option, which can be exercised at expiration only. That is a European option. Why American can be exercised before its expiry period, European option can only be exercised at expiration. So that is about option in brief. Another type of derivative contract we have is futures contract. So we are talking of futures contract are standardized contracts that allow the holder, notice please, is a standardized contract that allows the holder of the contract to buy or sell the respective underlying asset at an agreed price on a specific date. That is what we know as future. So the party involved in a future contract not only assess the right but also are under obligation, unlike the options where they have the right, but here it is both rights and the obligations to carry out the contract as agreed. So the contract are standardized. Please note all this. The contract are standardized, meaning that they are traded on an exchange market. They are traded on what? On exchange market. So that's that. The next one we have is forward contract. So we are talking about forward contract. Forward contracts are similar to futures contract in the sense that the holder of the contract possesses not only the right but also the obligation to carry out the contract as agreed. However, the forward contracts are over the counter. They are what? Over the counter contract. Over the counter contract, which we call OTC, over the counter contract, meaning that it is not regulated and it is not bound by specific trading rules and regulations. And since such contracts are unstandardized, that is not traded on exchange, organized exchange, they are traded over the counter and not by an exchange market. As the contracts are not bound by the regulatory body rules and regulations, they are customized to suit the requirements of both parties involved in it. That is forward contract. And the last one is swaps contract. So I'm talking of swaps. Swaps are derivative contracts that involve two holders or parties to engage in a contract in order to exchange financial obligations. So we have different type of interest. We have different type of swap. We have interest rate swap. We'll look at this in detail later. We have interest rate swap. And this is one of the most common swap contracts entered into by investor. So swaps are not traded on exchange. It is over the counter, like the forward. But the need for swap contracts to be customized to suit the need and requirements of the party involved are very germane. That this swap is never exchange traded contract, it is over the counter. So swap is a form of forward contract if it is done once. That is, if the exchange of the financial obligation is done once, it's a class of forward contract. But if it becomes serial, that's when it becomes swap obligation. Now, what is the criticism of these derivative markets? We are talking of criticism. Now, we are talking of criticism of this derivative market. The first one is the risk. The market is very volatile. Derivative markets are often criticized and looked down on owing to the high risk associated with the trading in financial instruments. You know, it is good for hedging as well, but if you don't understand it, the risk is far higher than the benefit you can get it if you don't understand the way it operates. So it's embedded with high risk. So the next one is what we call sensitivity and volatility of the market. Is under criticism. Under this one, many investors and traders avoid the derivative market because of its high volatility. It is never stable, and most financial instruments are very sensitive to small changes such as a change in the expiration period, interest rate, and so on and so forth, which make the market highly volatile in nature. That is a sensitivity and volatility. Is highly sensitive. A small change in interest rate or a date can render all the effort useless. And the next one is complexity. It is highly complex. It's not a function of a factor, it's a multi-factor function. So owing to the high risk nature and sensitivity of derivative market, it is often very complex subject matter because derivatives trading is so complex to understand, and it is most often avoided by the general public, and they often employ brokers and trading agents in order to invest in the financial instrument. That is on the complexity it involved. It's not something a layman can just go and do unless he or she want to waste money. And the last one is legalized gambling. Some people count it to be legalized gambling. Owing to the nature of the trading financial market, derivatives are often criticized for being a form of legalized gambling, and it's very similar to the nature of gambling activities if you actually look at it. Because in the beginning you don't know what you will make. It is when you get it later that you can be sure. Just like gambling, that when you stake a bet, you don't know what you are expecting to make, but it's after the time you make or you don't make, that one is left to you. So that is about the derivative market and instruments.